Hey, JJ here with the Art of Value. Well, it's Monday here, start of a new week in New Zealand, so not quite there in the US, but I just wanted to go through what might seem pretty pessimistic at first, but I'm going to finish on a pretty positive note. So what we're looking at, if you're just on audio, we're looking at the heat map of the last day, or last session. So we can see the Amazon down 14.05%, Google 3.72, Apple 3.66, even Apple, and Microsoft 4.18. Wow, what an end to April that was. I talked about this in the last video, but that's a very, if you're not on video, it's a very deep red heat map. And as it turns out, I've got a tweet here which goes through, talks about, it's from Charlie Bellello, and it's the Nasdaq Composite worst months this is going back to the 1980s. So we have number 12 being April 2022, minus 13.13%. And that's so number 12, and the number one was October 1987, minus 27%, which did rebound really well just in a few months after that. So that was kind of an anomaly, really. I mean, people talk about 1987 being a huge crash, but it actually bounced similar to March 2020. And March 2020 isn't on here as being one of the worst months. And that is, I had a check, and that's because it did go down like over 30%, almost 35%, I think. But it was from mid-February to about mid-March 2020, and then it rocketed up from there when the Fed started and the US government started stimulating the economy, and the COVID beneficiary stocks took off, and so that was quite a lot to do with the Nasdaq. So that's why that's not in this top 12, and I think it ended up only like 8% down for March or something like that. So, but March 2000, interestingly, there's like 1, 2, 3, 4, 5, 1, 2, 3, 4, 5 of these months that were the worst for the Nasdaq were in the 2000 to 2002 period, when there was after the dot-com bubble burst. So this is not, it's not necessarily maximum pessimism or fear right now, but as we'll see in the next slide I've got, this is from, oh, that's the wrong slide there. This is from the AAII, American Association of Individual Investors Sentiment Survey, which is, I think, a good one, better than the CNN like day-to-day index. So this measures individual sentiment from investors over time. It goes way back. So if you're just on audio, you won't see this, but of course you won't see this, but we have sentiment for the 27th of April, for the week 27th of April, was 59.4% of people bearish, 59.4% bearish, and bullish just 16.4%, and neutral 24.2%. And so that is extremely bearish, and there haven't been many periods where it's become that bearish. So historical averages are 30% bearish, and we're nearly at 60% bearish. And bullish historical average is 38%, and we're at 16%. And so the 1 year bullish high was 48.6, which was the end of June 2021, and the 1 year bearish high is right now for the last week. So we're in very bearish territory, and you can see this next slide is from the same sentiment survey, historical data over time, and we can see going back to December 2021. So this is not a huge, just the last few months, for the last quarter. So we can see that it's been becoming increasingly bearish over the last quarter. From December the 8th was 30%, which is kind of the lowest that I can see there, the lowest bearishness, and obviously sort of incrementally going up to nearly 59.4%. So there's no guarantees that this bearishness won't even go out further, but this is historically really high. Okay, and so jumping around a little bit. So this is one tweet from Michael Burry, who, you know, the Big Short. Michael Burry talks about, you know, the Amazon really dragged the market down on Friday. He says, this is a tweet, and so Amazon says to GDP, there's your weakening consumer. So he's very bearish on the economy. He talks about hyperinflation and there being a massive bubble. So is that playing out? We'll see. Another interesting, not an exchange, is from Bill Gurley. So Bill Gurley is a really prominent venture capitalist, Silicon Valley. And if you've seen, this is something that I posted on in an investment Facebook group in New Zealand. You may know this prominent venture capitalist from boards of various companies and as a main character in the TV mini-series Super Pumped, the battle for Uber. An interesting Twitter thread from him. So yeah, Super Pumped. I talked about that that I watched. Was it last weekend or a couple of weeks ago? Which I thought was good, and it was much better than We Crash, the miniseries about WeWork, I thought. But Bill Gurley was on the board of Uber. They were Benchmark Capital. His firm was one of the biggest investors in Uber, and there was a battle between him and the CEO. But it's worth watching. But anyway, he's also on the board of Stitch Fix, which I am invested in, and it's down way more than 70%, which he doesn't mention Stitch Fix, but he mentions 70% here. So what he says was, it was interesting. An entire generation of entrepreneurs and tech investors built their entire perspectives on valuation during the second half of a 13-year amazing bull run. The unlearning process could be painful, surprising, and unsettling to many. I anticipate denial. Some thoughts. So he's talking about the last 13 years and the fact that it could be over. Previous all-time highs are completely irrelevant. It's not cheap because it is down 70%. Forget those prices happened. Valuation multiples are always a hack proxy, dangerous to use. If you insist, 10x should be considered amazing, and an upper limit over that silly. So he's referring to, I guess, you know, expecting 100 baggers in the years going forward. You may be shocked to learn that people want to value out your company on FCF and earnings. Facebook trades at 14 times GAAP EPS and is growing 23%. What earnings multiple are you assuming? And number 4 and final point, revenue and earnings quality in all caps matter. So that's his 2 cents. And which is, I mean, you know, he's worth listening to. And the thing about this, also Jeff Bezos replied to his tweet, or quoted his tweet, and he said, Bill is without doubt one of the smartest people I know and always worth listening to. Most people dramatically underestimate the remarkableness of this bull run. Such things are unstoppable until they aren't. Markets teach. The lessons can be painful. All right, so we know how Amazon's done over the last 13 years. The last 2 years, not so hot. It hasn't really gone anywhere. But anyway, you know, I think that those words from both of those people are worth listening to. So the next thing I want to talk about is, I won't make this too long again, just trying to keep them relatively short if I'm doing these pretty much every day. So the Fed, so one from Dan Tapiero, who says on Twitter, the Fed can kiss the US housing market goodbye. Weekly mortgage applications are minus 65%. So obviously interest rates are going up and there are fewer mortgage applications. Market's still hot now, but just a matter of time before it cools. Leading data always ahead of the Fed. Liquidity contraction could become severe if they persist. And he's got a graph from Bloomberg which shows the decline in mortgage applications. So we'll see what happens there. Another interesting thought about is the housing market, and US housing market after a huge boom boom period in for trouble. People say there's a housing shortage. We'll see what happens there. I don't know. So the other thing was that the Berkshire annual meeting was in Omaha over the weekend, and results from Berkshire as well. The interesting thing was that Berkshire has bought 51 billion in equities in the last quarter. This is getting to the positive end of this. I said I'd end on a positive note, and here it is. A couple of things actually. Berkshire bought 51 billion in equities in the quarter. The cash is down to 102 billion, only 102 billion versus 144 in December. The buybacks 3 billion. So the buybacks were pretty heavy last year, and they've kind of gone down a bit, but still they've still been doing it, which implies that they think Berkshire is still below intrinsic value, well below. So where are we? Okay, so, and this is on the screen, we've got it states the activities in the first quarter for Berkshire, and you can see that they were buying heavily more in the second half of the quarter from February 21, so in January to mid-February. But part of that's to do with the transactions they made, but it's interesting that they are buying now pretty more heavily than they have for a long time. Is it a good time to buy? All trusted signposts like this point to yes. Not advice in the slightest, just an observation. And the other bright note is that what I didn't mention last time, I was going to, but I didn't, is that Chinese stocks just kind of rocketed on Friday in Hong Kong, and after some very positive comments from the Chinese government. So you see, if you're not seeing on video, but you might have seen this anyway. Alibaba in Hong Kong shot 15.69%. Meituan over 15%, Tencent over 11%, Baidu over 10%, JD.com over 15%. These are huge jumps in one day. BYD, which is the electric car and battery company, only 3.79%. But isn't this interesting that on the same day that the US market went way down, has the Chinese market bottomed finally after going down for more than a year? So I put this on an investor group again. Plot twist: Chinese e-commerce ripping in Hong Kong today. This was on Friday, my time, or Hong Kong time. Seems to be. This is from Bloomberg. Beijing is discussing with American regulators the logistics of allowing on-site audit inspections of Chinese companies listed in New York, say sources. It's a key step that's needed to stop delistings of New York traded Chinese firms. So the Chinese government is making consistent noises now about easing up on possible regulation or crackdown, as it's termed, crackdown of tech companies, and being more supportive and talking to the US about auditing. And so this has been very positive for the market. A lot of investors don't quite believe yet, but they are consistently kind of making noises in that direction now, and partly because the Chinese economy, real estate market's been in trouble, and obviously what's happening in the US, so they have sort of turned more supportive, and maybe this is positive for Chinese stocks. Don't know, not advice. And this last slide is actually, the US listed stocks and even on the OTC market. But Alibaba, of course, went up 6.8%, which is what it wasn't as much. But considering, if you compare it to what happened in the US, these were pretty much the only bright spots, and they were hugely positive compared to, the mega cap US tech stocks. So, even DD went up 3.87%, Baidu 3%, Baba 6.8%. So if you compare that to Amazon going down 12%, Baba up 6.8%, both e-commerce companies. JD.com 6.66%, similar. And Pinduoduo up 13%. So these Chinese e-commerce companies did the exact opposite of the US. All right, that's all for now. So please like and subscribe. Remember, the video for this is on YouTube and Spotify, so catch the video there. Otherwise, audio everywhere else. Thanks, like and subscribe, and I'll see you next time.